Warren Buffett just made a move that should terrify every investor. The Oracle of Omaha, the man who's never been wrong about major market crashes, has quietly sold $134 billion worth of stocks in 2024 alone. That's not a typo. $134 billion. His cash pile has exploded from $167 billion to $348 billion in just 2 years. He's hoarding cash like it's 2008 all over again. And what he's avoiding right now could save your portfolio from complete destruction. The hidden warning nobody talks about. Here's what the mainstream media won't tell you. Buffett isn't just selling random stocks. He's systematically avoiding 3 specific types of investments that are about to collapse. And if you're holding any of these, you need to understand what's coming next. The first thing Buffett has stopped buying: overvalued tech stocks. While everyone else is chasing AI dreams and paying 40 times earnings for companies with no profits, Buffett sees what's really happening. The Buffett Indicator, market cap to GDP, just hit 221.3%. That's nearly 3 times the historical average of 85%. The last time we saw numbers this insane, right before the dot-com crash that wiped out $5 trillion in wealth. But here's the part that should keep you awake at night. Buffett's Berkshire Hathaway has been a net seller for 10 straight quarters. They've sold over 600 million Apple shares worth $117.6 billion and dumped 41% of their Bank of America position. Historically, when Berkshire sells more than it buys for extended periods, massive market corrections follow within 12 to 18 months. This isn't just portfolio rebalancing. This is systematic wealth preservation on a scale that dwarfs entire national economies. To put this in perspective, Buffett's $134 billion in stock sales exceeds the GDP of Ukraine, Morocco, and Ecuador combined. When someone with his track record makes moves this dramatic, you don't ignore it, you follow it. The pattern nobody talks about. This exact scenario played out in 1999, 2007, and 2021. Each time, Buffett started hoarding cash 12 to 18 months before the market collapsed. In 1999, he was ridiculed for missing the tech boom while his cash position grew to $25 billion. The media called him out of touch and past his prime. Then the Nasdaq fell 78%, and suddenly everyone wanted to know his secret. In 2007, he was criticized for avoiding bank stocks while building a $44 billion cash fortress. Financial experts said he was missing the greatest bull market in history. Then the financial system nearly collapsed, and Buffett deployed that cash to make some of his greatest investments ever. In 2021, he reduced positions while everyone else bought the dip, accumulating $147 billion in cash. Again, the media questioned his strategy. Then we got the worst bear market since 2008, with the Nasdaq falling 35%, and growth stocks losing 70 to 90% of their value. The pattern is always the same. Buffett sees the warning signs, the media calls him wrong, retail investors mock his outdated approach, then reality hits like a freight train. And every single time, those who followed his lead preserved their wealth while the masses got slaughtered. The mathematical proof of market insanity. Let's talk numbers that Wall Street doesn't want you to see. The current market cap of all U.S. stocks is $58 trillion. U.S. GDP is $26.9 trillion. That 221.3% ratio has only been exceeded twice in modern history: 1999 and 2021. Both times ended in catastrophic crashes. But it gets worse. The top 10 stocks now represent 36% of the entire S&P 500. That's the highest concentration since the 1970s. When markets are this top-heavy, corrections are swift and brutal. In 2000, the top 10 stocks fell an average of 83% from their peaks. In 2022, they fell an average of 65%. Corporate debt has exploded to $12.1 trillion, up from $5.5 trillion in 2008. That's 45% of GDP compared to 31% before the financial crisis. When interest rates stay high, this debt becomes a noose around corporate America's neck. Buffett knows this, which is why he's avoiding leveraged companies entirely. The three things Buffett won't touch. First, meme stocks and speculative plays. While retail investors pour money into companies with no earnings, Buffett sticks to his rule: never invest in something you don't understand. The current meme stock mania reminds him of the 1960s Nifty 50 bubble, where investors paid any price for growth stocks. Companies like GameStop, AMC, and dozens of other meme darlings trade at valuations that defy all logic. GameStop trades at 50 times sales, despite declining revenues. AMC has $4.5 billion in debt against a market cap of $1.2 billion. These aren't investments, they're lottery tickets. When that bubble burst in the 1970s, some stocks fell 90% and never recovered. Polaroid fell from $149 to $14. Xerox dropped from $171 to $49. Avon went from $140 to $18. The same fate awaits today's speculative darlings. Buffett has seen this movie before. He watched the conglomerate craze of the 1960s, the tech bubble of the 1990s, and the housing bubble of the 2000s. Every time, the story is the same. Investors abandon fundamentals, chase momentum, and get destroyed when reality returns. Second, cryptocurrency and digital assets. Buffett has called Bitcoin rat poison squared, and for good reason. With no intrinsic value and massive volatility, crypto represents everything he avoids: speculation disguised as investment. The entire crypto market cap of $1.7 trillion is built on nothing but hope and greater fool theory. Bitcoin has crashed 80% or more 4 times in its history. Ethereum has fallen 90% from previous peaks. Thousands of altcoins have gone to zero. Yet somehow, investors keep believing this time is different. As institutional money flows into Bitcoin ETFs, Buffett sees the same euphoria that preceded every major bubble in history. When pension funds and insurance companies start buying speculative assets, you know the top is near. The smart money is already positioning for the exit. The crypto industry burns through $50 billion annually with no sustainable business model. It's a negative-sum game where the only winners are exchanges and early adopters who sell to later suckers. Buffett understands this, which is why Berkshire has zero crypto exposure. Third, overpriced real estate investment trusts, REITs. With commercial real estate facing a $1.5 trillion refinancing cliff and office buildings losing 40% of their value, Buffett has completely avoided REITs. He knows that when interest rates stay high, leveraged real estate investments become wealth destroyers. Office occupancy rates remain 30% below pre-pandemic levels. Retail REITs face permanent structural decline as e-commerce continues growing. Even residential REITs are vulnerable as home prices remain 40% above historical norms relative to income. The average REIT carries debt equal to 35% of its assets. When property values fall and refinancing costs soar, these companies face a liquidity crisis. Buffett learned this lesson in the 1970s and 1980s, when real estate investment trusts collapsed during previous interest rate cycles. The cash fortress strategy. Berkshire Hathaway now holds $348 billion in cash and short-term treasuries. That's more than the GDP of South Africa, Chile, or Finland. Most of this is parked in U.S. treasuries, earning approximately $17.4 billion annually at current rates. Buffett isn't hoarding cash because he's lost his touch. He's preparing for the buying opportunity of a lifetime. This cash position represents 40% of Berkshire's total assets, the highest percentage in the company's history. It's larger than the market caps of Tesla, Meta, or Berkshire's own stock holdings. When the world's greatest investor holds more cash than stocks, you should pay attention. History shows us what happens next. In 2008, while everyone else was panicking, Buffett deployed $15 billion in strategic investments that generated massive returns. He bought Goldman Sachs preferred shares yielding 10%, invested $3 billion in General Electric at favorable terms, and acquired entire companies at fire sale prices. His investment in Goldman Sachs alone generated $3.7 billion in profits, His GE investment returned $1.2 billion. His acquisition of Burlington Northern Santa Fe for $26.5 billion during the crisis has generated over $50 billion in value. These opportunities only come during major market dislocations. The same opportunity is coming again. The S&P 500's forward earnings yield of 4.25% provides only modest real returns above the current 2.7% inflation rate. This 1.5% real yield is historically low and signals compressed margins for error. When real yields fall below 2%, markets typically face increased volatility, and we're approaching the danger zone. The wealth transfer nobody sees coming. What's really happening is the largest wealth transfer in modern history. While retail investors chase momentum and pay peak prices, institutional money is quietly positioning for the crash. Buffett's actions aren't random, they're part of a coordinated strategy by the ultra-wealthy to buy assets at massive discounts. The Federal Reserve's own data shows that the top 1% increased their wealth by $15 trillion since 2020, while the bottom 50% saw their real purchasing power decline by $2.1 trillion. This isn't an accident. It's the result of a system designed to transfer wealth from impatient speculators to patient capital. Consider this. While retail investors poured $1.2 trillion into stock funds during 2020 to 2021, corporate insiders sold $1.4 trillion worth of their own company shares. They knew the party was ending and positioned accordingly. The same pattern is happening now, but on a much larger scale. Hedge funds have reduced their net long exposure to the lowest levels since 2008. Private equity firms are sitting on $3.7 trillion in dry powder, waiting for distressed opportunities. Sovereign wealth funds have increased cash allocations to 15-year highs. The smart money is preparing for the fire sale. The historical precedent. This exact scenario played out during the Weimar Republic hyperinflation. While ordinary citizens lost everything chasing speculative investments, wealthy families like the Rothschilds and Rockefellers accumulated real assets at pennies on the dollar. They understood that in times of monetary chaos, cash becomes king, but only temporarily. The Hugo Stinnes empire was built during Germany's hyperinflation by using cheap debt to buy real assets. The Krupp family preserved their wealth by converting paper money into steel mills and coal mines. The lesson? When currencies collapse, those with access to hard assets and patient capital win everything. The same families that profited from the 1929 crash, the 1970s stagflation, and the 2008 financial crisis are positioning for the next wealth transfer. Buffett's strategy mirrors theirs. Avoid speculation, hoard cash, and wait for the inevitable collapse. During the 1929 crash, Joseph Kennedy famously said he knew it was time to sell when his shoeshine boys started giving him stock tips. Today's equivalent is your Uber driver talking about crypto and meme stocks. The euphoria is identical, and so will be the outcome. What the numbers really tell us. Berkshire's cash position now exceeds their $263 billion in public equities. Think about that. The world's greatest investor is holding more cash than stocks. This cash pile is larger than the combined market caps of Coca-Cola, American Express, and Apple, three of Buffett's largest holdings. When you have $348 billion earning 5.2% in treasuries, that's $18.1 billion in annual income with zero risk. Buffett is getting paid $49.6 million per day to wait for the crash. Meanwhile, the S&P 500 at current valuations offers expected returns of just 3 to 5% annually over the next decade, according to most valuation models. The math is simple. Why take massive risk for 4% returns when you can get 5.2% risk-free? This calculation becomes even more compelling when you factor in the probability of a major correction. If markets fall 50%, Buffett's cash becomes worth twice as much in purchasing power terms. The Federal Reserve's hidden role. Here's what connects all the dots. The Federal Reserve has painted themselves into a corner. They can't raise rates without crashing the economy, and they can't lower rates without reigniting inflation. This is exactly the scenario that preceded every major market crash in modern history. The Fed's balance sheet still sits at $7.1 trillion, nearly double pre-2020 levels. This massive monetary expansion created the everything bubble we're living in today. Asset prices have been artificially inflated by $13 trillion in money printing since 2008. When that support is removed, the deflation will be spectacular. Federal debt has exploded to $34.5 trillion, requiring $1.1 trillion annually just to service the interest. That's 23% of all federal spending going to bondholders. When debt service consumes this much of the budget, fiscal policy becomes impotent during the next crisis. The Fed's own stress tests show that major banks would lose $685 billion in a severe recession scenario. Commercial real estate loans alone could generate $200 billion in losses. The banking system is more fragile than it appears, which explains why Buffett has been selling bank stocks aggressively. The insider selling tsunami. While the media promotes buy the dip mentality, corporate insiders are dumping shares at rates not seen since 2007. The insider selling ratio hit 8.1 to 1 in recent months, meaning executives are selling $8 worth of stock for every dollar they buy. Jeff Bezos sold $8.5 billion worth of Amazon shares. Mark Zuckerberg has sold $4.2 billion in Meta stock. Elon Musk liquidated $23 billion in Tesla shares. These aren't small portfolio adjustments. They're massive wealth preservation moves by people who know their companies better than anyone. The pattern is clear across every sector. Technology executives have sold $47 billion in shares this year. Healthcare CEOs have dumped $12 billion. Financial services leaders have liquidated $18 billion. When the people running these companies are selling, why are retail investors still buying? What happens next? Based on historical patterns, we're entering the final stage before a major market correction. The signs are everywhere: margin debt at record highs, retail investor euphoria, and institutional selling disguised as rebalancing. When the crash comes, and Buffett's actions suggest it's imminent, three things will happen simultaneously. Speculative investments will lose 70 to 90% of their value. Cash will become the most valuable asset for 12 to 18 months. Real assets will be available at generational discounts. The Buffett Indicator at 221.3% has only been this high twice before, right before the dot-com crash and briefly in 2021 before the bear market. Both times, markets fell 50% or more. The math is simple. When valuations are this extreme, corrections are inevitable. Margin debt currently sits at $684 billion, just below the $773 billion peak reached in 2021. When leveraged investors are forced to sell, the cascade effect amplifies every decline. We saw this in 2008 when margin calls created a feedback loop of selling that crashed markets 57%. The Buffett Playbook for Survival. If you want to survive what's coming, follow Buffett's lead exactly. Stop buying overvalued stocks immediately. The market is pricing in perfection while fundamentals deteriorate. With the Buffett Indicator above 220%, every dollar invested today is statistically likely to lose money over the next 3 to 5 years. History doesn't lie. These valuations always end badly. Build a cash position of 30 to 50% of your portfolio. This isn't market timing. It's risk management. Buffett has shown that cash is a strategic weapon when deployed at the right time. During the 2008 crisis, his cash position allowed him to make investments that generated 20% plus annual returns for the next decade. Avoid anything speculative completely. Meme stocks, crypto, SPACs, and leveraged investments will be the first casualties. These assets have no intrinsic value and depend entirely on greater fool theory. When the music stops, there won't be enough chairs for everyone. Focus on companies with fortress balance sheets. Look for businesses with minimal debt, consistent earnings, and pricing power during inflation. These are the only companies that survive major economic disruptions. Buffett's current holdings, Apple, Coca-Cola, American Express, all fit this criteria. Prepare for the opportunity of a lifetime. When markets crash 50 to 70%, the best companies in the world will trade at fire sale prices. Those with cash will be able to buy $1 worth of assets for 30 to 50 cents. This is how generational wealth is built. The conspiracy. They don't want you to see. The financial media won't tell you this, but Buffett's selling spree coincides with massive insider selling across corporate America. CEOs and executives have been dumping shares at rates not seen since 2007. They know what's coming, and they're positioning accordingly. Meanwhile, the same media that promotes buy the dip mentality is owned by the same financial institutions that need retail investors to hold the bag when the crash comes. CNBC is owned by Comcast, which has massive investments in financial services. Bloomberg is owned by a billionaire who profits from market volatility. Fox Business is owned by News Corp, which has extensive Wall Street connections. It's the oldest trick in the book. Get the masses to buy at the top while the smart money exits. The retail investor is always the last to know and the first to lose everything. Don't be the sucker at this poker table. The timeline for destruction. History suggests we have 6 to 18 months before the major correction begins. Buffett's cash accumulation accelerated dramatically in 2024, suggesting he sees the endgame approaching. The 2008 crisis took 18 months to fully unfold after the first warning signs appeared in 2007. The dot-com crash took 30 months from peak to trough. This one could be faster due to algorithmic trading and higher leverage throughout the system. High-frequency trading now represents 50% of all market volume. When algorithms start selling, the cascade effect will be instantaneous and brutal. There won't be time to react once it begins. The trigger could be anything: a major bank failure, a sovereign debt crisis, a geopolitical event, or simply the recognition that current valuations are unsustainable. The specific catalyst doesn't matter. The outcome is predetermined by the mathematics of extreme valuations. Conclusion: the choice is yours. Warren Buffett's warning isn't in his words, it's in his actions. The man who's generated 20% annual returns for 60 years is telling you something critical. This market is dangerous, and the smart money is getting out. His $348 billion cash fortress isn't just defensive, it's offensive. He's preparing to buy when assets go on sale at 50 to 70% discounts. The question isn't whether a crash is coming, it's whether you'll be positioned to profit from it or become another casualty. Buffett has shown you the way. He's sold $134 billion in stocks, accumulated the largest cash position in Berkshire's history, and positioned for the buying opportunity of a lifetime. The choice is yours. Follow the Oracle of Omaha's lead or join the masses who always buy high and sell low. But remember, in every market crash, fortunes are made and lost. The difference between the winners and losers isn't luck, it's preparation. And right now, preparation means following Warren Buffett's playbook and stopping the buying spree before it's too late. The wealth transfer is coming. The only question is which side you'll be on. Will you be among the prepared few who profit from the chaos, or will you be another victim of the greatest financial bubble in human history? The Oracle has spoken through his actions. The warning is clear. The time to act is now.